Hello everyone, and welcome back to the channel. Today, we're tackling a question that's fundamental yet often shrouded in confusion. What is the real difference between statistical learning and machine learning? If you've ever felt like they're the same thing, you're not alone. But for us as systematic traders, understanding this distinction isn't academic. It's the difference between building a robust, understandable strategy and chasing a black box model that blows up your account. I'm going to break this down for you, not with detached theory, but with practical examples in Python, Strategy quantx, and MetaTrader that you can apply immediately. Let's start by clearing up the core philosophical divide. Think of it this way: statistical learning is primarily about inference, understanding the why and the how. Machine learning is primarily about prediction, figuring out the what next. When you build a statistical model, you're playing the role of a detective. You're trying to uncover the true, underlying relationships between variables. You ask questions like, is this moving average crossover statistically significant in explaining future price changes? Or, what is the confidence interval for the coefficient of this RSI indicator? The model itself is a means to an end, and that end is understanding. The gold standard here is a p-value, a confidence interval, a measure of significance that tells you if your finding is real or just noise. This approach is deeply rooted in the mathematical study of data, assuming your data is a sample from a larger population and you're trying to make inferences about that population. Machine learning, on the other hand, turns you into an engineer. Your sole mission is to build a prediction machine that works. You don't necessarily care how it works, as long as it makes accurate predictions on data it has never seen before. The model is the end product. The gold standard here is not a p-value, but a performance metric on a test set, accuracy, precision, profit factor, or a low out of sample error. As one Stack Exchange user perfectly summarized, machine learning takes the practical, computer science point of view, focused on getting things done. The massive growth of the ML market, projected to be worth $79 billion by the end of 2024, is a testament to its powerful, results-driven appeal. Now, let's make this concrete with a simple Python example. Suppose we want to model the relationship between a simple moving average and future returns. In a statistical learning approach, we might use stats models for its detailed summary output. We'd fit an ordinary least squares (OLS) model and carefully check the summary table. We'd be laser focused on the p-value for the coefficient of our moving average. If it's below 0.05, we might conclude there's a statistically significant relationship. We'd also check the R-squared to see how much of the variance in returns is explained by our model. The goal is to understand and quantify this specific relationship. In a machine learning approach, we'd likely use scikit-learn. Our code would immediately split the data into a training set and a testing set. We'd fit a linear regression model on the training data, but our evaluation wouldn't stop there. The real test is using the model to predict on the test set it hasn't seen. We'd then calculate a metric like mean absolute error, MAE, on those predictions. We might even try a more complex model like a random forest to see if it can predict better, even if it's harder to interpret. The goal is purely the lowest possible MAE on the test data. This divergence in purpose leads to a critical difference in workflow, the handling of data. In classical statistics, it's common to use all your data to fit a model and then test its inferential power. In machine learning, this is a cardinal sin. The training-test split is non-negotiable. A model that only performs well on the data it was trained on is useless, it's overfit. Your test set is the ultimate judge of your model's predictive worth. This leads us directly into the trading workflow, and a tool like Strategy quantx is a perfect case study of this fusion. SQX doesn't force you to choose one camp, it leverages both. The core of its strategy generation is a machine learning-like process. It uses genetic programming to evolve and train thousands of trading strategies on a segment of historical data. It's optimizing for predictive power. Which strategy has the best profit factor or Sharpe ratio? But here's where the statistical learning mindset saves you. SQX doesn't just spit out the strategy with the highest in-sample profit. It has a whole battery of robustness tests rooted in statistical thinking. It performs out-of-sample testing, the ML principle, but also uses methods like a Monte Carlo simulation to understand the stability and significance of the results, the statistical principle. The vendor's own 2024 plan mentions adding new robustness test filters, showing this blend is actively evolving. So, your implementation plan should be this. First, use SQX's generative power, ML, to find promising strategies. Second, and most crucially, run them through the gauntlet of out-of-sample testing, walk-forward analysis, and Monte Carlo validation, statistical, before you even think about live trading. This brings me to a critical point about MetaTrader expert advisors, EAs. When you code an EA, you're implementing the final, tested logic. But the danger is baking the complexity of an overfit ML model directly into your trading robot. My strong recommendation is to keep the logic inside your EAs as interpretable as possible. Use the ML models for signal generation outside the EA, for instance, running a Python script on a server that sends simplified buy-sell signals to a simpler, more robust EA via a socket connection. This containment strategy limits your risk. A common pitfall is directly porting a complex, hyperparameter optimized model from scikit-learn into MQL5 code without a deep understanding of its failure modes. The EA then becomes a black box that will inevitably fail when market regimes shift. And that leads us to the most important part: risks and limitations. Let's be blunt. Both approaches can fail spectacularly if misused. The biggest risk with a pure machine learning approach in trading is overfitting. With enough indicators and enough complexity, you can always find a pattern in historical data. It's like having a key that fits a lock perfectly, but only that one specific lock. The mitigation is rigorous validation, a strict train, test split, using walk-forward analysis instead of a single split, and reporting metrics on the out-of-sample data exclusively. Don't be fooled by incredible in-sample results. For statistical learning, the primary risk is model misspecification. Your linear model might be beautifully significant, but if the real-world relationship is non-linear, you're still wrong. The p-values give you a false sense of security. The mitigation here is to use the statistical models for what they're good at, exploration and understanding, and to validate their predictive power using the ML toolkit. Both approaches face common enemies. Survivorship bias, only using data from currently listed stocks, data snooping, testing too many ideas until one works by chance, and the brutal reality of transaction costs and slippage. Your beautiful model might have a statistical edge, but if the bid-ask spread and commission costs are larger than that edge, you will lose money. Always subtract realistic transaction costs from your backtest results. A simple sanity check is to see if your strategy's performance degrades gracefully as you increase the simulated spread and commission. If it collapses, it was never robust to begin with. So, what's the takeaway? Don't see statistical learning and machine learning as rivals. See them as two essential tools in your quant toolbox. Use statistical learning to understand the market, to hypothesize about relationships, and to validate the sanity and significance of your findings. Then, use machine learning to build powerful prediction engines that can capitalize on those findings, but always cage them with rigorous out-of-sample testing and robustness checks. The most successful quantitative traders are not purely statisticians or purely machine learning engineers. They are pragmatic hybrids who understand the strengths and weaknesses of both worlds. That's all for today. I hope this has cleared up the distinction and given you a practical roadmap for your own strategy development. If you have your own experiences blending these two fields, or a horror story about overfitting, share it in the comments below. We can all learn from each other. Don't forget to like and subscribe if you found this useful. Until next time, trade safe.